What I want to talk to you about for roughly the next hour, and I'll leave time for Q&A at the end. Two things. First of all, I want to talk mostly about Venture Labs, which is something we've done together. And when I say we, both Jim Nolan and John Doggett were instrumental in helping get this program off the ground. As you know, Jim and John are responsible for teaching a lot of up-and-coming entrepreneurs, and we sort of pulled together some interesting stuff and a system that worked. And we've created Venture Labs, and the thing has absolutely been on fire since we pulled it off. I'm going to take you through all the detail on that. One of the other things I wanted to do to make it somewhat interesting for you too is the philosophy or the approach we're taking in making these startups work is with concept of what I call market validation. It's something I've been pretty passionate about for a number of years. And it's useful in business, so I'm going to spend a little bit of time touching on that. But again, mostly I want to talk to you about Venture Labs. And if you'll excuse me for just a minute, I had a little bit of, we had a little bit of PowerPoint. You have been shortchanged a little bit on the Texas Venture Labs slides, so I'm going to use a few slides you guys don't have access to. Excuse me for just a second. Sometimes when it rains, it pours on the PowerPoint front, if you know. We're all set.
Okay.
So first of all, again, the bigger picture is what we're doing with Texas Venture Labs is making it easier to get startups off the ground at the University of Texas. If you look around the campus, there's a wide variety of resources available all over. And for entrepreneurs who are aggressive while they're being students, a lot of times they can pull the stuff together. They can go find stuff out of the engineering organization, they can get up to ATI, they can pull stuff out of the business school, they can talk to guest speakers, they can buttonhole venture capitalists on the way back to the parking lot. And all these methods have been tried, and to some degree they've been very successful. I'll give you some examples of that. But what we're doing really with Venture Labs is pulling together a centralized resource where any student or faculty member who wants to make something work or make their best shot at getting the startup off the ground, we will help them do that. And philosophically, the approach we're taking is if anyone has been involved in a venture fund, which I have done many times, both raising the capital and running a venture fund, meaning as an entrepreneur raising venture capital, if you really look at what's inside a venture fund, it's a bunch of smart guys and gals with access to capital. In most universities, we talked about benchmarking today with the dean over lunch, benchmarking against other universities and what are we doing uniquely. If you look at most universities, when they try to do this kind of program, what they somehow confuse is the need to own the capital with the process of getting the companies off the ground. And if you look at the kind of environment we have here in Austin, you look at the kind of resources available on the campus, you look at the business community and everything else, there is no reason we need to have a fund associated with this. So first of all, what we did was disintermediate the smart people and the fund. And just briefly, the reason you don't want to necessarily have a fund is there are high overhead, takes lots of legal work, lots of accounting work, and typically the fund is very small and very specialized. So if you want to respond to what happens in the economy, if you want to move into green energy as green energy becomes popular, if you want to move out of technology as life sciences takes off, you're really constrained by having that capital. So when we benchmarked against the other universities doing it, we saw this heavy reliance on sort of anchor capital, And our approach was there is a lot of money available in Texas. A lot of that's available from venture capitalists. A lot of that's available from angel networks. There's some really good and innovative state funds out there. And we are going to rely on those sources of capital. And the value add we're going to create is we're going to help students pull together their deals, figure out the markets, vet the technology, get the licensing right, put together a plan, put together a management team if needed, not necessarily, partially of students, but also of outsiders, and get them to the right sources of capital, okay? So that is, if you're doing that for the first time as an entrepreneur, that can be an arduous process. If you take a systematized approach, And the fact that we've done it many times, we know how to push people through that extruder. So first of all, we are aiding and benefiting students and faculty on the campus in their process of building a company. And then if you go to the outside world, the business community, a lot of times they know there's a lot of entrepreneurial activity on campus, but they're not always sure where to go. Should they go to ATI? Should they go to idea to product competition? Should they come to Moot Corp? Should they go to the business school, the engineering school, the computer science school? And the value we're providing on the part of the people who have the money is we know what they invest in, we know how they like to invest, and we know they don't want to waste their time with a deal that's not yet ready. The entrepreneur might be overly enthusiastic, but frankly, the business is not ready to take on the money yet. So we provide value in that sort of bid-ask spread between what an entrepreneur wants to get and what an investor wants to put their money in. So a few words that go with this, and the reason I'm so careful is, like any organization like this, there's all kinds of rumors about what we are and what we aren't. I'm not going to read these words to you. I pretty much explained them already. But the real goal is to give both students and faculty the experience of going through this process, okay? So, as well as providing us a research bed and an academic learning environment. The reason I put these slides up, and I'm so careful about this, and Jim's heard me say this before, is it was just interesting to hear the rumors of what we were doing and what we weren't doing as we were getting this thing off the ground. And the best rumor was we were taking over the football program. So that's not true. But I would ask is if you can help spread the word and spread the word accurately, that'd be great. The how. The thing we're doing is really stripping out the intellectual horsepower needed to turn ideas into businesses. If you look at the investment profile, or if you look at any venture capital investment profile, typically the investments made, if the investment's made at this point, there's this famous thing called the J curve, where the value of the company goes negative for some period of time and then eventually comes back, okay? And that J curve, that negative value, can be anywhere from about 6 to 24 months into the life of the company, and usually involves $500,000 to $1 million worth of capital on average. So what we're saying is we will take the people who are in the labs, and I'll talk to you more about where we get those people, and put them on these deals. And rather than that entrepreneur having to go out and raise all that money, which can be dilutive and can be very risky for the investor, we're going to apply smart people, and instead of putting money into the deal, we will give the smart people course credit. They'll put their smartness into the deal, and out the other end will come a deal far more ready for investment than before. So the way we're mitigating risk for the entrepreneurs and the investor is just making this investment in, again, things like what's the market paying, what's the business model, how do you make money doing this, who buys it, who pays for it, all the basic things that most entrepreneurs in their fits of excitement sometimes leave out when they go to talk to investors. And the uniqueness of this is not a big picture, we're going to build this out over 5 years and I'll get back to you with the results. We've actually been doing this. Myself, again, Jim Nolan, John Doggett, many of you in the audience have taken some or all of our courses. Many of you have gone through the Moot Corp process or the Venture Fellows process. And we have had many companies over the last 5 years go out and raise serious investment capital. And when I say that, I'm talking in the millions of dollars from professional institutional funds, and we have not provided them any of that capital. They have gone out and raised that money out on open, highly competitive markets. A lot of these people, the average person doing this is typically a freshly minted MBA out of the full-time evening or executive program. Now that is not the juiciest profile from an investor standpoint, okay? Usually you want somebody with more than that level of experience. The other thing is it's been very hard to raise venture capital over the last 10 years, okay? The returns have been extremely poor. So when you look at the ability of these people to raise money in this environment, it's a phenomenal success story, okay? It's absolutely stunning. And again, I'll go through a few examples just because they're pretty interesting. So what are sort of the key takeaways here? First of all, when you think venture labs, think of essentially a venture capital firm, okay? Smart people working hard to take the risk out of deals, but we're not managing the capital. We're just doing the fun stuff, okay? We're doing the stuff where students can be taught or have experience and can apply that in this environment. So we're using outside sources of capital. We're going to Austin Ventures, we're going to Seven Rosen, we're going to Benchmark Capital on the West Coast. We're taking advantage of the Emerging Technology Fund here at the state of Texas. We're taking advantage of Capco funds. We're taking advantage of government grants. Any source of capital that makes sense, we will help the company figure out what's applicable to them and then help them go get it. We are not reproducing any on-campus or business organizations, okay? We're not trying to be an incubator. We have that in the form of ATI. We're not trying to provide legal advice. We have many great law firms here in Austin. Anything that's already available is not what we're doing. What we are is really a consultation and acceleration service for these companies. What we are doing also, as you'll see, is we're beginning to take on certain projects. I'll talk about the criteria for those. And the goal is, as we start, I'll talk about the time frame in just a second, but we're starting in the Graduate School of Business, McCombs, Graduate Law School, and Graduate Engineering School. That's kind of our core focus for the first year. We're going to perfect the model there and roll it out. And sort of the how we're doing it, if you just look at these concentric circles, the core of it's academics and research, okay? We now have our own sort of laboratory where we can look at profiles of companies at work, begin to understand the kind of classes that really matter to these people. We have some great entrepreneurship faculty here who do a lot of research. This will provide a great environment for them. Next ring out is the campus organizations. Again, things like ATI, Austin Technology Incubator, which is a great resource for us. Things like the Venture Fellows Program that Jim runs, where people learn how to be venture capitalists. I2P, which is an idea to product competition coming out of the engineering school. Office of Technology Commercialization runs things like Ready to Commercialize, where they kind of highlight the technologies that are available from the University of Texas. Next concentric ring out is business organizations. Again, there's a lot of these organizations in Texas, and particularly in Austin, where kind of this, a lot of entrepreneurial roots come out of Austin. So we're able to leverage a lot of the existing organizations. So we're able to run a very lean, tight ship that's really just focused on getting these businesses built. This is the process we use. It's not particularly fancy. You see 4 stages of deals here. If you look at the bottom left-hand corner, that's really when you've got a raw idea or some raw research or some technology. As we graduate up to the second stage, we get that idea or technology into a market. We figure out what the market opportunity is. I'm going to talk more about this towards the end. But the key thing is, as far as educating students and entrepreneurs, is getting them to understand that without a market, there's no company. Okay? Sounds pretty fundamental, I know. But we really push the fact that the world's greatest technology does not mean a thing without a machine behind it making money from that technology. We call this concept market validation, and we spend a lot of time with it. And we'll talk more about that. Part and parcel of understanding what the market is what's the business model. Okay? I could have a great idea, I could find a great market, but if I can't make money, if I can't profitably serve that opportunity, it doesn't matter. So we push heavily on that point. As you get into stage 3, we help them with the management team, we help them get the funding as we've spoken about, and we do the launch stuff. Frankly, stage 3 is probably about the easiest step in this process. A lot of the horsepower goes into stage 1 and stage 2. Stage 3, as we help them go out and raise the money, becomes the real test, okay? A lot of companies don't get to stage 3. Why? Because there's not enough there. And one of the things we educate people on constantly is the key to startup is a fast failure. okay? If you're not going to make it, you want to know in 3 to 6 months. You don't want to spend 4 years of your life and mortgage your house and cash in your kids' education fund trying to make something work. So if you hit stage 3, the overall probability of making it to stage 3, if you look at the numbers, is about 10%, okay? We think, based on some of the data we've looked at and some of the experiences we've had, we think we might get it 20 to 30%. And when I say 20 to 30%, meaning 20 to 30% of the deals we push forward will actually get money, okay? And then beyond that, stage 4, ongoing mentorship, growth, and harvest. And we've had some deals recently, harvest, that I'll take you through in a second. But those are the 4 big steps we take them through. And again, each one of them, we're providing the people, the arms and legs, the mental horsepower to get them matured, to reduce the risk, to make the probability of the success higher for the entrepreneur, and make the investment more attractive for the investor. Here's sort of the timeline we're running on. If you look at the top thing, March 2010, we've started the program. Right now we're focused on stage 3 and stage 4 deals. We have several of those in the works. Starting in September 2010, we're going to go back into stage 1 and stage 2 deals. If you notice, September corresponds with the fall semester. Jim Nolan, John Doggett, and myself have been actively recruiting sort of the best and brightest on the entrepreneurial front from the MBA program, from the graduate engineering program, and from the law school. The response has been phenomenal. We're looking for 25 people, and last I checked, we had 75 people who want to apply, and we had to put up a lot of barriers, make it fairly difficult to apply. When I say difficult, I don't mean busy difficult, but they're going to make investment decisions, show us their investment decisions, make presentations, and the quality of the people we're getting and the motivation of the people we're getting is just totally off the charts. Okay, I think this reflects what we're seeing in the U.S. today. We are a high labor cost society, as Dean Gilligan always likes to say. Innovation is critical. Okay, and whether these students are going to go work in a large company like a Google or a Southwest, which is highly entrepreneurial, or they're going to start their own businesses, they have to know how to do this stuff. Okay. The other thing I like to say in one of my wisecrackier moments is, whereas a startup used to be option number 4, 5, or 6 for somebody getting their MBA, a lot of times now it's job option number 1, 2, or 3. So we are taking full advantage of that. So that's going to happen in September. And then as we get down bottom right-hand corner in 2011, we're going to expand beyond the graduate schools of business, engineering, and law and go to those undergraduate programs. Okay? And then 2012 and beyond, we want to go cross-campus, both undergraduate and graduate. And what we would picture over the longer term as we continue to perfect and scale this process and continue our fundraising efforts, what we would picture over the long term eventually is having a campus-wide business plan competition. We find that business plan competitions are a very real way to get people to really push their business to the maximum, and you'll see the results of why I'm saying this in a minute. But we would picture, for instance, the School of Music having a business plan competition, the School of Pharmacy having an undergraduate business plan competition, undergraduate engineering, each school having its winner, and then having a campus-wide undergraduate business plan competition where we'd sort of pick or help prioritize who the top plans were across the campus. Now, one of the reasons we believe in these business plan competitions, and any of those of you who have taken New Venture Creation with Gary Cadenhead or myself, or have participated in Moot Corp, we have been able to substantially increase the quality of the deals coming out of those programs over the last 5 years simply by competitive pressures, peer pressure, okay? And the people who are winning or even doing well, not even necessarily winning, but finishing in the top 3, the companies are raising money. Again, and when I say raising money, outside institutional investors, 7 to 8 figure investments, okay? And let me walk you through a few of these because there's just some really interesting ones. Far left-hand corner there's a guy, a PhD from Johns Hopkins who got his MBA here, a company called Halsa. I'll tell you a little vignette on a few of these just because I think they're pretty interesting. Halsa Pharmaceutical, they're actually building or they have a patent on a fat pill, a fat reduction pill. Let me tell you how this works. Phil was getting his PhD in molecular biology at Johns Hopkins. Johns Hopkins does a lot of cancer research. What they were looking at was in cancer patients why they waste away, why they lose so much body weight. Hopkins was. And they isolated it down to two naturally occurring biologics. One was a biologic that caused your muscle to deteriorate, and one was a biologic that caused your fat to deteriorate. So what Hopkins wanted to do was figure out what was causing the muscle wasting and block that from happening. And Phil said to him, well, while you're figuring that out, can I have that fat wasting gene or biologic? And do you mind if I run with that? And long story, that's an oversimplification. He spent about 3 or 4 years worldwide chasing patents down rat holes to make sure he got all the intellectual property cleaned up. But he is just coming out of animal trials on this natural biologic. If you know the pharmaceutical process right now, he's still got to go through 3 stages of FDA trials. But there's 2 interesting things that are happening here. First of all, not only does this product help reduce fat, but it also helps significantly on diabetes and insulin uptake. So all of a sudden, he has something that's a huge a potential, not proven, but potential cure for one of the bigger problems in the US, which is weight-related diabetes. The other thing is, if you look at pharmaceutical companies, over the next 5 years, something like $60 billion of pharmaceutical drugs are coming off patents. These are things like Lipitor, all the cholesterol, blood pressure drugs that drive these huge pharmaceuticals. So all of a sudden, he's in the envious position of getting even a bigger market than he originally thought. Meanwhile, some of the pharma companies are desperately, the term they use is insourcing promising compounds. And what they used to pay for a phase 3 cleared deal, they're now paying for a phase 2 cleared deal. So he's raised about $5 million to date. His exit value could be substantial. He still has a lot to prove, don't get me wrong. If anyone is familiar with the FDA process, that is not a simple process. But the initial results and all the research that's been done is very promising. So that's Halsa. I'll skip over to the 2 to the right. There's a guy there in QQ, Barry Kahn. QQ, Barry's actually a PhD in economics from the University of Texas. He teamed up with an MBA, and QQ is cracking the secondary ticket market. If you look at the price difference between a NFL, Major League Baseball, NBA ticket, what the cash face value is and what it gets sold on at the street, there's about $6 billion a year of markup that occurs essentially by scalpers. Okay? So what happens is the venue, the ballpark, the baseball team or whatever really takes all the risk in putting on the event. And sometimes if it's a hot team playing on a summer day on the weekend, the price can be substantially higher than the face value. They're providing a real-time pricing system that lets the ballpark or the music venue capture the true value of the ticket versus the face value. Best example I can give you is it's just like airline pricing is today. Okay? You want to fly to New York City in 3 days, you're going to pay a premium price. You want to fly to New York City in 6 weeks and are willing to put up the money early, you're going to get a much lower rate. So it's really that same concept, in this case applied to sports venues and music venues. Company's doing very well. They just closed an ETF round to the tune of about $2 million in the process of hiring a management team. I'll cover 2 more with you. Those on the top are less seasoned deals. They're still sort of have a lot to prove. They've got plenty of capital and they have customer traction. But if you look at the bottom, This first one on the left, UShip. This is a team of 3 MBAs. I know they took Jim's course. I know that they took New Venture Creation from my predecessor, Gary Cadenhead, and I know they took John Doggett's course. But Matt Chasen, who you see there, is the CEO of the company. And UShip is a shipping service for outsized products. If you go to UPS or FedEx or the US Postal Service, they have those nice, neat little boxes, you know, that come in sort of perfect shapes. And if your stuff fits into those, you just drop it at the corner and the box disappears, and $3 or $4 or $5 later, it arrives where it's supposed to arrive. That works well and good, but if you want to do a bicycle or a chest of drawers or a couch or a motorcycle or a car or something that isn't easily fit in those packages, the price from those carriers goes up anywhere from a factor of 5 to 10. Okay? So what they did was they saw this. They saw the emerging market for eBay, where a $50 chest might get sold. Nobody's going to pay $300 to ship it. And they went in and stepped into the void there and basically ended up doing a kind of an arbitrage between available space on trucks and vehicles and people who wanted to move their stuff. So now, and eBay is a primary market, not their only market, but now if you go to eBay and you buy an outsized product, you're going to get an offer, would you like to ship that with UShip? And typically, using their service, they end up being 30 to 70% of the cost of what a commercial shipper would normally charge. So it's a really interesting business model. They have raised close to 8 figures of venture capital from Benchmark Capital, which is a top-tier West Coast firm. They're doing very well. They're profitable at this point in time. They're based in Austin, Texas. And the MBA from 5 years ago, who's now gray-haired, is still the CEO, which is really an amazing story. And then the last one I'll take you through, this is our best success to date. Furnace Software here on the right, Daniel Nelson right there. Daniel started this company with his, he got his MBA here at University of Texas. He started it with his undergrad roommate here from the University of Texas. And this is a software product. I'll describe it quickly. It's Install Shield for Java. And if you've ever installed software on your Windows computer, you know, this little box comes up and it says, do you want to install this? And you kind of just hit return and take all the defaults and hold your breath and hope the thing doesn't totally melt the computer down. Okay? Well, corporations have the same problem when they do that with networks. And best example is when Walmart goes and changes their servers, they have to do it at night, and they can't afford to have their servers go down simply because their cash registers won't work. Walmart's one of their customers. IBM's one of their customers. He took New Venture Creation and competed in Moot Corp 4 years ago at the Texas level. He won it. We helped him raise 3 rounds of capital, very creatively structured. He gave up some equity in the company, but not a significant amount. We got him a CEO. And 4 years from the day he got out of here, he sold the company to BMC just in December of this year for a significant 8-figure number. So the investors were thrilled. We got some real happy founders. We've got a nice CEO who thinks wonderfully of the deals coming out of here. So as you can see, this process has been going on for quite a while. Okay? We're not doing anything wild and esoteric. We're just making these deals work. We've just been a skunkworks kind of setup up until now. And this is our big opportunity to go public with it. And I'll talk more about how you as alumni can get involved. Organizationally, faculty directors right now, that's loosely me and a whole bunch of students. We're hoping to bring on more. We're going to have a series of postgraduate manager positions as we scale this thing across campus. Obviously, we need some form of, we would need sort of classic organizational structures. What we're looking at is post-MBA, postgraduate kinds of positions where people who are highly motivated that want to do a startup or work in venture capital would come in and for modest salaries spend another year with us helping get this off the ground. And then day-to-day operations staffed by students. Okay, we give them experiences in venture capital, entrepreneurship, and entrepreneurial, operational positions, so they get to know what these things look like. And what does a student get in this? First of all, we take no equity in these companies. Okay, it's not our goal to take equity. This is a learning experience for these people. The students who work in it get a combination of, first of all, course credit, which matters to them. Okay, that's a currency they get. And then also they get relevant experience. Okay, all of you have your degrees from here. Who wouldn't have wanted to say, yeah, when I got my MBA or when I got my undergrad, I helped 8 companies move from this point to that point. 3 of them ended up getting funded. Okay, and obviously, there's no guarantees of jobs with them, but if they've worked with people before and had a chance to sort of test drive them coming through the labs, the students, I mean, the probability that that student gets hired goes up dramatically. Okay, and these just a couple quick initiatives. We talked about these, most of these already. The way we're running. Let me talk to the Venture Week piece right here. One of the things we're running out of the labs is we're picking a week every semester. It looks like it's going to be one of the last weeks of school. And we're trying to run a South by Southwest kind of convention where we have entrepreneurial things drop in that week. Okay, so it might be the Moot Corp business plan competition. It might be the idea to product competition run by Steve Nichols out of the engineering school. Might be ready to commercialize, run by the Office of Technology Commercialization. Our ATI runs a lot of seminars on clean energy and things like that. So we're trying to have a week each semester that any entrepreneurial faculty, investors, alumni, former students, anything like that might want to come back and sort of make all those things hit in one week. The other thing we're talking about here, just to keep the process objective in how we do these deals, is automated advisory board deal screening. One of the things we're doing is relying on lots of outside expertise. Again, this is where alumni have the opportunity to come in. We intend to be able to handle any kind of deal. So if we're doing a consumer deal, we'd love to know who of you have experience in consumer products. If we're doing a software deal, we'd love to know who of you have experience in software, manufacturing, energy, anything like that. We're relying on outside expertise and things like the alumni network simply because that's the best way to do it. Okay? Investors are not omniscient. They cannot figure out what's going to work and what's not going to work, particularly at this stage of investment. We need domain knowledge, industry expertise. And that's what we'll turn to you. So again, I apologize. There was a bit of I shorted you on some of the slides. The website for this is www.texasventurelabs.net. And there is, we have not yet implemented it because we're just trying to get accurate information up, but there will be, within the next 3 or 4 weeks, a section on how to get involved. If you're interested in being a mentor, if you're interested in being an advisor, if you're interested in being an investor, we'd love to hear from you. And the reason we want mentors and advisors is, again, to expand our expertise. Okay? If we can tap into the network, into the alumni network, it's just a great source for us. Let me shift gears for just a minute. I've got about 20 minutes left. I'm going to speak for another 10 minutes and then open it up the last 10 minutes for Q&A before I turn it back to Jim. Let me just run you through quickly the concept of market validation. And I mentioned this briefly beforehand. This is what we try to instill in deals coming through the university, okay? And I'm passionate about this. As Jim said, I've written 2 books. One, A Good Hard Kick in the Ass, has been out for a while. That's about venture investing. And the If You Build It, Will They Come comes out April 12th. That's all about market validation. And the reason I bring that up is this is what I did my PhD thesis on. This is the stuff I do. And this is what I have found and the data has shown doesn't assure success, but dramatically increases the probability of success. If you look at the reason a product works or the reason a product or service doesn't work in the market, 85% of the success or the failure lies in how well the company evaluated the market to figure out what they should deliver before they built it. Okay? Before they built it. The typical entrepreneur puts their foot on the gas, does what I call fire, 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 ready, aim. And in the process, that's why they go out of business. What we're trying to teach them is ready, aim, 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 fire. Simple concept, okay? But that's what makes a deal have a higher probability of working. And the problem is the numbers are stacked against you, okay? If you look at a typical startup, 90% of all startups fail, okay? 10% succeed. Biggest category of startups is typically restaurants, if you look at any economy. You know why? Because everyone thinks everyone has to eat. And I know how to cook, you know, how to ruin a good hobby, turn it into a business. If you look at the data coming out of smart companies, meaning well-educated people with domain knowledge in the category they're going into, and they're not capital constrained, meaning they have some sources of money, not infinite sources of money, but some sources of money, that usually you can get that probability of success up to about 20%. So you can roughly double it. Then if you look at products coming out of existing companies where it's not their only product, they have enough critical mass that one product is not going to make or break them. Actually, the product failure rate for existing companies is 70%. Okay, 30% likelihood of success. So the challenge with the startup is if your first product or service fails, the startup goes away. If you look at established companies, 75% of the time the product fails. And the definition of failure is 3 years later, that product or its subsequent release is not available in the market. And the thing we try to push them on is, technology, manufacturing, accounting, statistical analysis, quality assurance, all that stuff matters. There's no question about it. And it has to be done right. But the real reason a product will succeed or not is they focus, an over-focus on the operational issues and an under-focus on markets, okay? If you look at classic education today, it focuses on the top half, operational issues. Give me some data, I'll crunch the data and I'll figure out everything about it. Give me the quality assurance data, I'll figure out where the problem lies. Give me the supply chain data, I'll figure out how to squeeze more efficiency or more money out of it. And the thing we push them on and try to get them comfortable with is stepping into a more amorphous, looking at the bottom half, a more amorphous, less tangible way of looking or process of evaluating the market, okay? Most people would much rather go down to a production facility that has 10 steps and see how many widgets are at each of the 10 stations and figure out how many are coming off the line. That's easy. The harder part is picking up the phone and calling a potential customer or a customer who just returned the product and figuring out why. And asking them simple questions like, what is this worth to you? What don't you like about it? Who's my biggest competition? We push this constantly, okay? The mantra is you've got to find market pain that's high sense of urgency and willing to pay. And if you can get those two things, if you can find the market with significant pain, high sense of urgency, and willing to pay, a good management team will find a product or service and technology to protect it. And that's the fundamental process we walk them through in trying to figure out markets. I'm just going to close with my favorite example of this. It's a bit of a negative example, but it works really well. Iridium phone system. I don't know if any of you are familiar with it, but the Iridium phone system was launched by Motorola in the early 90s. And the whole concept was, in the late 80s, a group of engineers went to Galvin, who was running Motorola. It had been run by the Galvin family for many years, and said, hey, listen, all these cell phones are coming out. We have a good semiconductor market. We sell a lot of chips to them now, but there's this competition. We got Nokia coming up on us, and we've got several semiconductor manufacturer companies coming in the cell phone area at us. If you look at the world, there's copper infrastructure and cell phone infrastructure. Let's make a third infrastructure, which will be satellite-based. Okay? And the whole idea behind Iridium, and the reason it was called Iridium, is you needed that many satellites to blanket the globe, the same number of electrons as the iridium atom has. Okay? It was 87, I believe, satellites. Had to go up around the globe. And the challenge is, in order to make a phone call, if I'm here in Austin and I want to talk to Jim and he's in Antarctica, I got to be able to pick up the phone in Austin. It's got to go up to the satellite here, all the way down, back down to Antarctica for us to have a phone conversation. And the way Motorola, which is an engineering-driven company, got all excited about the engineering challenge, right? How to get an engineer excited, tell them there's something that's really hard, please go fix it, okay? The world loves doing that. So all the engineers got totally geeked up. They built an incredible system. They launched all the satellites. They figured out the power supplies, how to get everything right. They figured out how to build the headsets. They spent $8 billion on the technology, launching the technology, getting it up there. They turned it on, and literally the phones did not ring. Okay, and I don't know what the capital payments were on $8 billion. I didn't take Jim Nolan's course. But I imagine that the daily payments, or the burn rate was pretty significant. They then went and looked at how they evaluated the market. And all they did was evaluate secondary data from government institutions that showed international traffic. Typically, phone companies are very regulated. Most countries try to tax the inbound and outbound calls pretty heavily, so it's pretty easy to get data on this. Their theoretical market was the international business traveler. But there were a few things they forgot to ask. For instance, first of all, in the early 90s, when there were cell phones pretty widely available, and most of them were very portable, their cell phone was about the size of a World War II walkie-talkie. Okay, big, heavy old thing, lots of battery power needed. Depending on what country you were in, you had to put all kinds of parts into it. Okay, so you needed 2 days of systems training to figure out how to use the phone. The real kicker, and again, this was from Motorola, which was a cell phone company, the real kicker was the thing could not work indoors. Okay? It had to be able to see the sky. And because you have to hold these headsets near your head and you can't fry your brain with radiation, they couldn't make them too powerful. So basically, you had to go out and stand in the open air to send and receive a call, which means you couldn't use them indoors, means you couldn't use them in most cities just because the sky's blocked. So you had to go to the roof in New York City to use your fancy-dancy phone, and usually it took about 5 tries to get a call to go through. Once the call went through, you had what's called a propagation delay, right? It's like calling the space shuttle or the space station. You can't have an interactive conversation. You have to stop and wait for the other person to respond. So anyway, this is the example I like to hammer home. Technical challenges are easy, but it would have been real simple to go out and validate this market opportunity beforehand. Oh yeah, and by the way, it was about $10 a minute to use the phone. So, one of the things we go through is what's the simple 3 questions you'd ask 100 people to figure out if they'd buy the Iridium phone before you spent $8 billion. And just an example we like to use to reinforce it. By the way, Bill Gates put money into this thing, Craig McCaw put money in this thing, Motorola put money in these things. And what we're really trying to teach them is it doesn't matter who backs it. You cannot make something that wasn't designed to work. For those of you who are interested in the follow-up, Remember, I also talked about business model and whether the economics of the system work. Iridium went into bankruptcy. The lawsuits flew. They're still flying from what I know. It was bought for about half a cent on the dollar out of bankruptcy. And the company recently went public again because on the reduced capital structure that bankruptcy forced them through, it was a very profitable business. And now what they do is they have specialized phones. They are parked in a warehouse outside the FedEx building in Tennessee. And if you were to call and you're heading to a war zone, if you're a ship at sea, if you're an oil drilling rig, if you're anything that needs backup communication, you basically end up renting this thing for a couple grand a month. So it's just a great enforcement of the example. You got to validate the market because you can build just about anything you need to. And number two, you got to make sure that the cost to build it is such that it'll be bared by the market. So those are the two key things. And again, this is what I spend my life doing, and this is what we try to pass on to our students. So that's the end of my formal talk. I'd love to take a few questions here before I turn it back over to Jim. And thanks for, I know it's hard after a full day here. Michael.
So basically you're saying that if they had validated the market, they would have found out that that was the specific use for the technology they came up with, and been better able to kind of gauge what kind of product they were making and what the business case was.
Exactly. And for those of you who couldn't hear the question from my former student, by the way, it was, hey, listen, so basically you're saying validate the market, make sure that the market will bear the price. Yes. And the example we like to use, the validation exercise I always like to tell them is, listen, we'll go to the Barton Creek Mall on a Saturday morning. We'll look for business people with cell phones on their, in their hands or something, and we'll make them a deal. Let's say I walked up to Jim Nolan here and I said, Jim, I got a deal for you. I'm going to pay your cell phone bill for 3 months, okay? You call anywhere you want in the world, no problem, I'm covering it. But there's a couple constraints I'm going to put on you. First of all, you have to tape this brick to your phone. Second of all, you can only use the cell phone with the brick taped to it outdoors. And the last thing is I'm going to take the calls you make and I'm going to show you what they would have cost using my satellite phone system. And, of course, the question is, if you talk to 100 people at Barton Creek Mall, 100 business people, on a Saturday, if you ask them those 3 questions, how many takers do you think you'd get? And the point is, an $8 billion decision was driven off something that didn't even involve that level of decision making. So if you want to be crafty, if you want to be, innovative, if you want to be a true entrepreneur, this is the kind of stuff you got to pay attention to. Anything else? Other questions? Yes, sir. Great question. The process we have in mind to pick the companies, and first of all, this process is up on the website, okay, texasventurelabs.net. But for the September timeframe, when we've got lots of people to put on the deals, there's a submission process up there. We are going to take any deal, we're going to take all the deals and then turn to our advisory board. Remember, I talked about that advisory board, and ask them to help us evaluate which deals are the best. So we might have, if we had half a dozen life sciences deals and half a dozen manufacturing deals, just as examples, we turn to you, and you on the life sciences, and these 3 experts over here on the manufacturing side, and say, based on a cursory description, give us your opinion based on your expertise in that particular industry, which sound the most promising, okay? And our goal is to use this outside system to vet the prioritization we use. Because again, there's urban legend that, investors somehow know how to pick something and pick up some shaggy dog, clean it up, and turn it into some super mutt. And that's just not the case. What you have to do, the real key to success is compelling market opportunity. So we would turn to networks like all of you to help us evaluate which had the most compelling market opportunity. And by the way, you hear that investors invest in management teams, absolutely true. And the theory is, you give me a good market opportunity, that's the most important thing, and an aggressive management team that knows how to react to it. If you give me those two things, the likelihood of a deal working increases. It's never guaranteed. But again, that's not an investor sitting here going, oh, I can pick that that's going to work and that's not going to work. That just doesn't work. That is not possible. If it was, there'd be one very good investor in the world. So. Yes, sir.
What's your opinion on using market validation in the opposite way to kind of identify a needed product rather than validating a product?
Okay, so there's two ways to go at market validation. One is find me a compelling market opportunity, I'll reverse engineer a product to it, okay? The other is give me a technology and let me go figure out what markets make the most sense. It really doesn't matter which one. In a theoretically perfect world, you want to do the market first, okay? That's usually the most capital efficient. But also, in doing market first, you have to have some starting thesis. You have to say, hey, I think this is going to fit in general over here. So if you turn around and have a technology that could be pointed at a few markets, it's really just as effective. A great example is I was with Pfizer in New York City earlier this week, and we were going through market validation. And their challenge is they're a discovery-based model, which is what you're talking about. They grind up rocks and root stumps and stuff out of the Amazon and try to figure out if it fixes anything, okay? If they did market validation, market first, well, they know we need a cure for cancer, right? It doesn't take a genius to figure that one out, but they do it the other way. They figure out which compounds have some kind of effect on the body, and then they go at it the other way. It's just a little less efficient in the general case, but when you look at an organization like this where we have lots of potential technologies on the shelves and lots of people who can run around figuring out markets, it should work out very well. Next to him, yes. Yes.
I can imagine what you mentioned about some ideas being driven by technology. Engineering school, for example, might yield people that work, like 3M and those things, technologically driven. Whereas some people that might go to law school, or maybe eventually if you want to get into the music school and get entrepreneurs, you'll have to deal with ideas that are not necessarily based on technology, but
yes.
opportunities. How do you bridge that gap?
Right. So the difference between a technology deal and a non-technology deal. Well, most deals coming out of the business school are not technology deals, okay? Of the the 8 I showed you, 2 are pharmaceutical deals. Those are the only real hardcore technology deals. Usually what you try to find is, usually a good team can figure out some secret sauce that gives them what I like to think a 6 or 12 month head start getting into a market. Okay, some technology, some business model, some process that gives them a little breathing room before the competition starts jumping in on them. Yes, sir, in the back. How do you protect the entrepreneurial idea itself? Well, this is another great urban legend, and I love to play with students on this. There's always this concern that somebody's going to steal my idea. And again, one of my things is ideas are a commodity. It really doesn't matter. And in all my investment experience, I have never, ever, ever seen any idea taken in its formative stages. Never. Now, if you found a market and you grew to $100 million in 2 or 3 or 4 years, people are going to jump on you like white on rice. But we just have not had I have never seen an idea taken. It's the execution part that matters, and that's what we try to push them on. And for the record, just so we keep ourselves real clean, not only do we not take positions in these companies, we do not sign non-disclosure agreements, okay? Investors do not sign non-disclosure agreements. We do not sign them, okay? We believe that, and we're not sharing stuff, but we believe that it's the ability of the team to go execute and figure out something to protect it. That's the difference between making it and not making it. All right. Well, let me go ahead and thank you very much. Please check out the website.